Hi, this is Matthew Cratter from Trader University, and today is going to be part 2 of how to pick stocks like Warren Buffett. If you didn't see my video from yesterday, I'm going to link to it below. It would probably make sense for you to watch that video before watching this video. If you're interested in how Warren Buffett invests, if you're worried about this bear market, or just want to see how I'm trading it, be sure to hit that subscribe button. So yesterday, just to recap very quickly, we talked about how Buffett likes stocks that have a strong brand and other investment moats, like the network effect, huge scale, etc. He also likes sort of consumer products companies, Gillette, Procter and Gamble, Coke, these kind of companies. And so there was a good question that someone had in the comment sections below. It was Tyler. He was asking me about the PE, or the price to earnings ratio, for Procter and Gamble, which is obviously another big consumer products company. They make Tide, they make Crest toothpaste, they make Downy, just a ton of products. Looks like they also make very different brands of toilet paper as well. So let's just talk about the PE and whether this might be a good investment. Procter and Gamble used to be a Buffett stock. He bought Gillette, which obviously makes men's razors and shaving cream. He bought them many years ago. Gillette was acquired by Procter and Gamble. Procter and Gamble, when they acquired Gillette, Warren Buffett exchanged his shares in Gillette for shares of Procter and Gamble, and then he ultimately sold Procter and Gamble. I think it was in 2016 or so, just to make room for other things in his portfolio. So that's the basic background. Procter and Gamble is definitely kind of a Buffett-like stock, but it appears right now to be trading at a very, very high PE. So let's just drill down a little bit more on that. So we're going to start by looking at other consumer staples companies. Coca-Cola would be really the classic one. And if we go to Yahoo Finance and we look at its PE, currently a PE, a 12-month trailing PE of about 23, and a forward dividend yield of about 3.53%. So if you buy Coke right here at these prices, you'd expect to have a yield or make about 3.53% on your money, which is decent considering interest rates are close to zero. And as we'll see, these consumer staple stocks, they really do function almost like bonds in this environment. They're fairly slow growing, but they do pay a dividend, and so they allow investors who are hungry for yield in their portfolios to capture some of that yield that they used to be able to capture from bonds and can no longer do. So let's just talk about sort of relative valuations here. Coke has a PE of 23, dividend yield of about 3.5%. Pepsi, which is a little bit faster growing company than Coke, ticker is PEP. It has a PE of around 25 and a half, and a dividend yield of 2.88%. You'll see these consumer staples stocks tend to trade in this environment. They trade more based on their dividend yield than based on their PE. So anywhere between 2.5% to 3.5% dividend yield. If the company has closer to 2.5% dividend yield and it's a consumer staples company, you can assume that it's growing revenues and earnings more quickly, or that the market thinks it will continue to do that going forward. If it's growing a little bit more slowly, so for example, Coke has been, it's had flat to negative revenue growth, sales growth for a few years, so it trades at a slightly lower PE and a higher dividend yield. So you'll make more on the dividend yield, but you won't make as much from capital appreciation unless they can turn things around and start growing more quickly. But either way, we're seeing PEs sort of the low to mid 20s, dividend yields between 2.5% and 3.5%. So then when we look at Procter and Gamble, which as we said is kind of a classic Buffett company, PG is the ticker. If we look at its PE, well, let's first look at its dividend yield. Dividend yield is as we would expect, 2.59%. So probably growing a little faster than Coke, or at least the market's pricing it that way. But then when we look at the PE ratio, it has a PE ratio of 64, which is a very, very high PE ratio. This is more the kind of PE ratio that a high-tech company will have when it's growing revenues very quickly. And so for a slow-growing company like Procter and Gamble, we can look at they've been growing their revenue growth of just 1.2% over the last couple of years. We can see their net income has actually gone sharply down. We'll see the reason for that. Fairly low return on assets and return on equity. And so this is a blue chip company, not super risky, more of the kind of company you hold to collect this dividend yield. But why is it trading at such a crazy PE, and this was Tyler's question. So let's just dig a little bit more into that. Now, it would appear that the dividend yield at least is trading within the range we would expect, but why is the PE so crazy? Well, price to earnings ratio, the PE, is just the price of a stock divided by the earnings per share, or the market cap of the company divided by net profits. So let's take a look at the income statement for Procter and Gamble. I'm just on the financials tab here on Yahoo Finance, ticker PG. I'll stick a link to this in the description notes below. And let's just take a quick look at the income statement. It's important if you're going to invest, especially if you're going to be kind of a dividend investor or value investor, it's very important to learn how to read income statement, balance sheet, and cash flow. And as Warren Buffett says, this is really the language of business. So let's just go through this really briefly. You can see these are annual numbers, 2016, 17, 18, 19, then the last 12 trailing months. If we look at their total revenue, it's trending up nicely. It's gone from about 65 billion to 69 billion in the last few months. Now these numbers look like they're millions, but as you can see up here it says all numbers are in thousands. So this is what we'd expect. This looks like it's growing about 1-2% a year. Very slow revenue growth, but it's a very big company. Not the most exciting area, selling toothpaste and stuff like this, but sort of a dependable workhorse type of a company. If we look at operating income, which is really the income from business, from the actual operating business, before you look at things like taxes and interest expense and extraordinary expenses, that sort of thing, we can see that it's grown from about 13.4 billion up to 15 billion in the last few years, since 2016 to 2020. And so that exhibits a sort of nice slow upward growth that we would expect from a conservatively run company like this. So everything looks good so far. Now, if we scroll down and look at net income, we can see 2016 net income of 10.5 billion, 15 billion the next year, about 10 billion. Then all of a sudden, in 2019, the net income falls off a cliff. And when net income goes down, this is how you get such a big PE number, because the PE is just the market cap divided by the total earnings. And so when this number drops, when the earnings drop, the denominator obviously gets bigger. And so, when the earnings drops, the denominator gets smaller, which makes the whole ratio bigger, and that's why you get such a large PE. But if we drill in a little bit more, we can see that, okay, obviously the operating income is looking good, but then something weird happens when you drop down and you're looking at interest expense, other expenses, income tax. Everything looks fine except this line. You can see that there's a 7.474 billion loss in this total other income expenses. Now this is, when it's below the operating income line like this, it's usually an extraordinary expense or a one-time thing. And so let's just drill a little bit more down and see what exactly that would be, because obviously the operating income number 14 billion looks fine. It's just when you subtract this huge 7.5 billion number that it just totally crashes net income and gives you that really high PE. So if we drill down, I'm going to go to Morningstar now. If you just type in Morningstar PG, 2 words, and then click on financials, click on income statement, it'll take you right here. And this is arranged a little bit differently. We have on the left side, we have 2015, 2016, all the way up to the present. And so we can see the revenue line up here, operating income, bear with me here. Okay, so this line right here, total operating profit or loss, we can see that looks about the same, trending around 13 to 50 billion. And then when we scroll down, and these numbers are all in billions here, they're slightly different, we can see that the big hit happens right here, irregular income and expenses. And this is marked, this has a negative number in front of it, so it is it counts as an expense, obviously, minus 8.35 billion. So let's break this down. We'll open it up a little bit, and we'll see that under here, the main item, the minus 8.35 billion, comes in the form of a goodwill impairment or write-off. Now, this is a one-time event. You can see that it doesn't happen every year. And I need to back up a little bit to explain what this means. Basically, when a company buys another company, so Procter and Gamble bought Gillette, and they had it on their books at a certain carrying cost. And then if that company starts to have problems, and the company that's been acquired is not worth as much as the acquirer paid for it, what they need to do according to generally accepted accounting rules is do what's called a write-down, where they write down the value of that business, that acquired business, on their books. And when they do that, they take a charge that flows through to the income statement. Now, Gillette used to be a very good business, but men's shaving habits have changed slightly. People seem to be shaving less, and there are also a lot of little competitors, like Dollar Shave Club, some of those sort of internet startups. And so the value of Gillette, which was acquired, which PG&E bought in, I want to say 2005, the company is not worth as much. Gillette is not worth as much. And so what they do is they reduce the value of the company as they're carrying it on the Procter and Gamble books, and they take a charge which flows through. So we can see they took an $8 billion charge, roughly, rounding. It flows through to the income statement, and it doesn't impact operating income, but it does impact net income. So it subtracts out $8 billion, and that's why we see this huge fall off where net income from continuing operations, or we can even look at all the way down here. Let's scroll down here. Net income goes from 10 billion, all the way down to 4 billion. And that is simply because this is a one-time charge that is happening, a one-time charge of 8 billion. So if we go back to Yahoo Finance, we go back to the income statement, and we basically need to take an adjustment. So what we do is we take this one-time impairment, and we add it back to net income. So if you take 7.8 and we add it back to the net income down here, which is about 4.8, so 4.8 plus 7.8, so that gives us about 12.6 billion. Now this is a one-time write-off of Gillette, so it shouldn't. Theoretically, Gillette could continue its decline, and they might need to do another write-off. You normally do it when there's been a big move in the value of the acquired company. But we can see here, once we make this adjustment and we add back this impairment charge, that we get back up to net income of 12.6 billion. And so if we let's go and look up the market cap of Procter and Gamble. Let's see, where's the market cap? Market cap is 284 billion. So we say 284 divided by 12.6 gives us a PE. Well, let's just write that down. 284 divided by, what did we say? 12.6. Just make sure. Yeah, 12.6 equals about 22.5. We'll call it 22. So we can see once we make this adjustment that Procter and Gamble is actually trading at a very similar PE to Coke, which was at 23, and Pepsi, which was at 25. And so the market is very smart. It figures out these things. And this is something that's important to remember when you're valuing a company. You want to look at normalized earnings or core earnings, or however you want to call them. And you want to ignore one-time fluctuations. Now, obviously, the value of Gillette could continue to go down. Maybe people don't buy as much of Procter & Gamble's other products on the toothpaste side of things. So you have to have a view that the company is going to stay stable, or at least grow slowly as it's been growing. If you have write-down after write-down, if this becomes a regular thing, then maybe you have to take it into account. But one-time write-offs or write-downs really don't alter the fundamental forward value of the company, or what it can produce in net income going forward. So that's why we make this sort of income statement adjustment. And you can see that the market's very smart. It's already done it, and Procter & Gamble is thus trading at a PE that's in line with its peers. So then the final step would be, if we're interested in buying this, mainly for this dividend yield, is to say, how does their debt situation look. So we can go back to Yahoo Finance and click on statistics. And if we scroll down here, we can see the line under balance sheet for total debt. They have about 29 billion in total debt. We said they're making, call it 10 or 12 billion in net income a year. So they could pay off all their debt in 2 or 3 years. This is a very conservatively run company, not super leveraged, not a long-term debt. If it's going to take a company more than 5 or 6 years to pay off all its debt in a theoretical situation, then that might be a much more levered company. But we can see that this is trading, the total long-term debt is about 2 or 3 times, call it 3 times the sort of normalized net income. So all in all, not a very exciting investment. And you have to have the view that these sort of core brands don't further decline. But otherwise, it's certainly, we would not want to say that this company is massively overvalued. There's just this weird thing that's happened in terms of having to write down the value of Procter and Gamble and Gillette. If you want to dig a little bit more into what I did here and really learn how to analyze financial statements and become more of a Buffett-like investor this way, check out my online course, Financial Statement Analysis Made Easy. And as we said, Buffett calls accounting and financial statement analysis the language of business. And so if you take this course, you can learn how the income statement works, balance sheet, cash flow statement, etc. And it'll really bring you up to speed. Now you can get access to this course and actually all of my courses for a fixed low price. So you can get access to Learn to Trade Stocks Like a Pro, Swing Trading with Options, Bear Market Trading Strategies is a good one to check out right now, Price Action Trading, Futures Trading, Fixed Income, whatever you're really interested in. You can get access to all of these courses for just $125 for 30 days access. Now times are rough, and so I'm going to give you a coupon code to use. If you scroll down, I'll put a link in the description notes below. You can click on any of these courses and you can see the curriculum inside of them. And then if this is something that interests you, just go down here and click Get It Now. And that will take you to the checkout page. And as I said, normally $125 for 30 days access. Click here where it says have a coupon code. Type in YT, as in YouTube, 99. Click Update. That'll take $26 off the price and make this a really, really good deal. There's no community college or business school or school of accounting that charges this little. So if that's something that interests you, if you're not really in the market for it right now, feel free to keep watching all my free YouTube videos. I also have a bunch of books on Amazon, which I'll link to below, which are just $2.99 a piece if you want to save some money. But if you really want to go deep and you have a lot of free time right now, you're home because of the virus, and you want to, instead of just binging on Netflix, you really want to pursue some more self-education, these courses are a great way to do it, especially if you enjoy my teaching style and find this sort of stuff interesting. Thanks a lot for listening. Hope you found this video helpful. Hit that subscribe and like button if you haven't done so already. And let me know your questions in the comment section below. Also let me know if you have any suggestions for what I should make my next YouTube video about. Thanks a lot for listening, and I'll see you in the next video.